Hey, before we dive into today's picks, I want you to know that I've added timestamps for each company, so feel free to jump around to the ones that interest you most. I really don't mind. And I'm also tracking all these picks in a spreadsheet you can access through the link in the description below so you can follow along with their performance in the months and years to come. How you doing? I'm Russ, and I've been intentionally investing since 2018, so please do remember that this is just for fun and entertainment. Recently, I was sitting in traffic behind a waste management truck, and I thought about how difficult it would be to replace trash collection and disposal because of AI or technological advances. So today we're looking at 7 companies that have 2 very important things in common. First, they make exceptional returns on their money, what we call return on capital employed, or for the remainder of this video, ROCE. And secondly, they have products or services that they sell and should stay valuable even as artificial intelligence changes our world. Before we jump in, if you're interested in following my dividend journey, I'm now on Blossom. It's like Instagram, but for investors, where you can see my actual portfolio moves in real time. And also, don't forget to sign up for my free weekly dividend newsletter, where I share some of my peculiar investing insights and portfolio activity. And there are links for both of those in the description below. Return on capital employed tells us how well a company makes money from the money that it invests in their business. So think of it like this. Putting $100 into a business and getting $20 back yearly is a 20% ROCE. And all the companies that we're looking at today have a 10-year average ROCE of at least 20%, which is exceptionally outstanding and indicates the business likely has a moat. So before we look at each company, I think this is what makes most of them special, is that they each have physical products or services that AI won't easily be able to replace, strong distribution networks that would be incredibly expensive to replicate, loyal customers who depend on their services, growing dividend payments which shows their financial strength, and the proven ability to adapt to change while maintaining their profitability. First up is Lincoln Electric, ticker LECO, which was founded in Cleveland, Ohio in 1895. They are the world's largest maker of welding machines, and they have paid a dividend every year since 1915. They are AI resistant because they have physical welding equipment that can't be replaced by software. They're actually benefiting from AI by integrating it into automated welding systems. And take it from yours truly, welding requires human skill and judgment that AI can't replicate. So all the numbers for ROCE come from finchat.io, where I ran a screen, and Lincoln Electric has a ROCE 10-year average of 24.68%, so 25%. And then we'll be using all the fundamental data, getting a 10-year look back through simplysafedividends.com, where it's a little bit pricey, but don't forget that you can try Simply Safe Dividends free for 2 weeks, no credit card required, and I am not affiliated with them in any way, shape, or form other than a happily paying customer. So Lincoln Electric gets a dividend safety score of 98, very safe. They have a dividend growth streak of 30 years, and they're currently paying $3 per share per year, which right now is good for 75 cents per quarter. Simply Safe gives them a reasonable valuation at the higher end of the 161 to 196 expected price. And again, if you don't know how this works, what Simply Safe Dividends did is they take the 5-year average PE ratio and they go 10% above and 10% below. And that's the gray shaded area you can see where the stock price is the gray line. So that's all that valuation is. We don't know that that's going to happen, but just a reference for you to keep in mind. Their dividend yield of 1.55% is about in line, a little bit below the 5-year average of 1.62%. Their free cash flow payout ratio, I love to look at that over earnings per share, is only 29%, so they have plenty of room to keep growing that dividend. They had a huge jump up in free cash flow per share in 2023 to $10.10. Sales growth was booming at 22% in 2021, now down to 3%, and they could have negative earnings per share growth next year. They do have a little bit of cyclicality, but by and large, total sales is moving up and to the right, and they continue to buy back shares, currently down to 57.8 million outstanding. Really high margins of return on invested capital and return on equity. And look at that free cash flow margin, 14%. That means out of every $1 of revenue coming into the business, 14 cents is making its way to free cash flow. And with free cash flow, you can do things like buy back shares, pay the dividend, invest back in the business, do things like mergers and acquisitions, and carry it as cash on the balance sheet. Net debt to capital, 41%, which isn't anything too crazy for this business. And what the ICR, or interest coverage ratio, tells us currently for Lincoln Electric is 14.57. That means for every $1 of interest on the debt, they have $14.57 of operating income to easily cover that. So they have no problem paying the interest on the debt right now. Next up is Pool Corporation, ticker POOL, which is the world's largest wholesale distributor of swimming pool and backyard products. They started as South Central Pool Supply in 1981 and went public in 1995. They now operate 440 sales centers in North America, Europe, and Australia. They're AI resistant because swimming pools need physical maintenance and chemicals. They have a massive distribution network that would be highly costly to replicate, and their local relationships and services simply can't be digitized. Pool Corp has a 10-year ROCE of 36%, dividend safety score of 69, safe, and you can see the valuation right here too for easy reference. Currently also at the high end of their reasonable valuation. Pool Corp has a dividend growth streak of 13 years and a last dividend raise of 9.1% in May of 2024, so they do grow that dividend pretty fast. Pool Corp is paying $4.80 per share per year, or $1.20 per quarter. Again, they're at the high end of the reasonable valuation according to SimpliSafe. Their dividend yield of 1.27% is pretty high, above the 5-year average of 1.06%. Trailing 12-month free cash flow payout ratio, almost the same as Lincoln Electric, 28%. So really, really low. They can easily pay that dividend. Similar to Lincoln Electric, they too had a big jump up in free cash flow per share, but that's been tapering off a little bit. Could be facing some recessionary headwinds, but they're still making a lot of free cash flow per share. There you go. They have negative 10% sales growth in 23, and the trailing 12 months, negative 7%. So something to watch out for. They haven't had negative sales growth. And before that, they hadn't had any negative sales growth, at least going back to 2014. Like most of these companies, they buy back shares down to 38.6 million outstanding. Now we'd like to see the total sales to keep going up and to the right. For Pool Corp, they peaked at 6.18 billion in 2022, and it's starting to drop off just a little bit. Monster return on equity and return on invested capital numbers. Love to see a return on invested capital of at least 15%. Hey, last 12 months, 12% free cash flow margin. You'd like to see that. They've been paying down debt pretty aggressively since 2018, so that's good to see because they're down to 48% net debt to capital, and that ICR 12.13, and prevailing wisdom is you kind of want to see that over 4 or 5, giving you some wiggle room in case of interest rates rising and things like that. So 12.13 is very, very good. Next, Visa, ticker V. They got 4.5 billion Visa cards in over 200 countries and territories. They're connected to 14,500 financial institutions and over 130 million merchants. And as of the 12 months that ended June 30th, 2024, Visa handled 296.8 billion transactions. And why Visa should be AI resistant, their global payment infrastructure is nearly impossible to replicate. They use AI to enhance security, not replace their core business, and their network effects grow stronger with each new user. Now, Visa, as my guy Ryan Williams says, is pretty much the gold standard. They have a ROCE of almost 30%, dividend safety score of 99, very safe, and according to SimpliSafe's valuation, they're actually toward the lower end of the reasonable valuation. Yeah, super fast dividend growth, 18% 10-year CAGR, 16% last raise in October of 2023. So they're about getting ready for another raise on that dividend. Visa's hitting you with $2.08 of dividends per share annually until they raise it again, which right now is 52 cents per quarter. There you see they're at the low end of the reasonable valuation according to SimpliSafe. About right smack dab in the middle of their historic historical dividend yield of 0.72%. They're at 0.73 right now. And this is where it's fun. Free cash flow payout ratio, stupidly low at 22%. So they can easily raise that for years and years to come. Every once in a while, their free cash flow per share is lower than the year before, but then they jump right back up. And the next 12 months is expected to be almost $10 of free cash flow per share. Other than the black swan event of the COVID crash and all those shenanigans that went on, sales growth is almost always in the double digits. Last 12 months, total sales, again, at an all-time high, and they continue to buy shares back, currently at 2.04 billion shares outstanding. These margins are just awesome. There you go, 36% ROIC, return on invested capital, 50% almost return on equity. Look at this nutty free cash flow margin. It's dropped off a little bit, but still, out of every $1 coming in sales, almost 55% is making its way to free cash flow. They are just printing money at this point. Visa's net debt to capital, virtually non-existent. It's jumped up to 0.09% the last 12 months. And the interest coverage ratio, $36.08 of operating income to cover every $1 of interest on the debt easily. Number 4, we got Rollins, ticker ROL, which was founded in 1893 as Waltham Pest Control. They're the parent company of Orkin, which they bought in 1964. They operate in over 70 countries and employ over 19,000 people, and they kill bugs, which is why they're AI resistant, because pest control requires physical intervention. You can't just digitize roach removal. They have local expertise and human judgment, which remain essential. And even with automation, pests will always be a biological problem, and food safety regulations will always require pest control services. So Rollins has a ROCE of almost 31%, dividend safety score of 83, very safe. Simply Safe says they may be undervalued with an expected price of 47 to 57. They're currently, as of this recording, at 46. They have a dividend growth streak of 3 years, and that's because they cut the dividend during the COVID pandemic. So, hey, black swan events happen, but they have more than raised the dividend previously to where it was, with a 5-year CAGR of 17%, which is very fast, and they last raised that dividend 10% in October of 2024. So we've got a fresh dividend raise hot off the press for you, which is currently paying 66 cents per share per year. And there we see they do look to be at the lower end of the expected price range, which shows they may be undervalued. The dividend yield of 1.42% is above the 5-year average of 1.20%, and the forward PE is 42, which is below the 5-year average of 47, which seems crazy, but those are their numbers. But not as crazy as a 54% free cash flow payout ratio for a bug company. So that's really low, and they do keep it below 60%. So that gives us the warm and fuzzies with the dividend. Last 12 months, they're at $1.11 of free cash flow per share, which was an all-time high, and that's expected to grow in the next 12 months. Double-digit sales growth going back to 2021. In the last 12 months, it was 11% for Rollins. And their shares have mostly been kept flat, but they did drop from 490 million to 484 million over the last 12 months. Total sales every single year just stair-stepping up and to the right. This is indicative of a very, very healthy business. And look at that. Oh, their return on invested capital fell from 43 to 24%, which is still really high. We're currently hovering around the 30% range. Very good free cash flow margin at 16%, operating margin even at 20%. Now, Rollins' net debt to capital shot up from 17% to 39% in 2023. So we would need to know why that happened and if they made an acquisition or the like, but they've started paying that debt down, currently down to 37%. And yeah, they have no problem paying the interest on that debt, currently at $20.99 of operating income to cover every $1 of interest on their debt. Number 5, Domino's Pizza, ticker DPZ, which started with one store in Ypsilanti, Michigan in 1960. Domino's is now the largest pizza company in the world with more than 20,500 locations in over 90 markets worldwide. And heading into 2023, Domino's was the #1 carry-out pizza company in the United States and delivered 1 of every 3 pizzas. They should be AI resistant because people will always need to eat food, and many people love their comfort foods. Local food preparation can't be fully automated, and they are using AI to improve delivery efficiency. Now, Domino's Pizza has an incredible 10-year average ROCE of 93%, but they only get a dividend safety score of 55, borderline safe, and after some recent headwinds, they look like they're undervalued with the stock price in the low 400s, and Simply Safe expects the price of the stock to be somewhere around $4.39 to $5.37. Now that is some hot dividend growth. 20% 10-year CAGR, and they last raised the dividend 25% in February of 2024, and they've been growing that dividend for 10 straight years. The DPZ is hitting you with $6.04 of annual dividends per share until they raise it again, likely in the early months of 2025. And again, there you see they do look to be undervalued with an expected price of $439 on the low end, and they're currently at $415. Domino's dividend yield is 1.46%, which is above the 5-year average of 1.11%. Look at that forward PE. The 5-year average is 28.6%, currently at 24.4. Nice and low free cash flow payout ratio of 40%. And it's expected to be even lower at 34% over the next 12 months. $14.30 of free cash flow per share. Analysts think over the next 12 months, that could be almost $18 for an all-time record high. That was one of the bugaboos, was the negative 1% sales growth 2023. One of the reasons some people are selling off, but over the last 4 months, hey, at least it's positive at 4%. They do like to buy back their shares outstanding, currently down to 35.1 million shares outstanding. And with the total sales, hey, it looks like they hit a bit of a plateau starting in 2022. So you see negative return on equity, and that's something that you don't have to be too worried about because some businesses that are really aggressive with their share buybacks and also pay out dividends sometimes can exceed the shareholders' equity, and you have that negative return on equity. So with a big company like Domino's Pizza, a mature and stable company, it's really not something to worry too much about because Starbucks is very similar to Domino's Pizza like that. But then this is another telltale sign, a stupidly high return on invested capital of 72%. Very healthy operating and free cash flow margins from my vantage point, what I can tell with Domino's Pizza. And again, this is something we would need to double check, but Simply Safe says they have no net debt currently, but net debt to EBITDA, that's earnings before interest, taxes, depreciation, and amortization. The last 12 months, when you see 4.85, it means that it would take Domino's 4.85 years of EBITDA to pay off that net debt. And Simply Safe likes to see that, or would prefer to see that under 3.5 turns. And if there's one thing you could nick them on, it's the interest coverage ratio. It's been right around in the low 4s, currently at 4.41. So you'd like to see that a little higher, and as Simply Safe would like to see at least above $8 of operating income to cover every $1 of interest on the debt. Number 6, Home Depot, ticker HD, was founded in 1978 in Atlanta, Georgia by Bernie Marcus and Arthur Blank after they were fired from Handy Dan Home Improvement Centers. They operate over 2,300 stores in 3 countries, and in March of 2024, Home Depot acquired SRS Distribution for $18 billion to accelerate Home Depot's growth with the residential professional customer and increase their total addressable market. Probably obvious why Home Depot is AI resistant, because physical tools and materials can't be digitized. In-person shopping experience remains really valuable for contractors, believe me, I know, and the massive scale in physical locations creates a competitive advantage. Home Depot's 10-year ROCE is almost 50%, which is just outstanding. Dividend safety score of 87, very safe. Simply Safe has them at the high end of their reasonable valuation. Home Depot has a dividend growth streak of 15 years. They had been raising it very fast with a last 20-year CAGR of 19%, and they last raised the dividend, 7.7% in February of 2024, but they have some very, very nice dividend growth. And Home Depot's annually hitting you with $9 of dividends per share, good for $2.25 per share per quarter until they raise it. And as we already saw, toward the high end of the reasonable valuation, the dividend yield of 2.24% is actually below the 5-year average of 2.41%. And that forward PE is a bit higher than the average 5-year, so kind of overvalued right now for Home Depot. Their free cash flow payout ratio, 52%. They're expecting it to be right at that sleep well at night line that Simply Safe gives of 60%. Their free cash flow per share hit an all-time high in 2024. Last 12 months, it's down to $16.90. And over the next 12 months, they expect it to potentially be even down to $14.90. And for the first time in a long time, Home Depot has had negative sales growth. And that could be a telltale sign of a recession starting to rear its ugly head, right? Home Depot is currently down to 994 million shares outstanding, so they do somewhat aggressively buy back shares. Their total sales looks like it hit a plateau in 2023, and it's hovering around $152 billion. So there you go. With dividends and aggressive share buybacks, could be some of the contributing factors to them having really wild swings on the return on equity, but the return on invested capital, again, we want to see at least 15% for a really strong business, and they are well over that. But you know, the margins are starting to compress. Free cash flow margin's still pretty good at 11%. Nothing to worry about there. Now, Home Depot, the net debt, you don't like to see this, 94%. That's a little bit too high, but because they have a lot of earnings coming in, you can see it's only 2.31. So if they wanted to, they could probably pay down that debt a bit more aggressively. And there you go. They have no problem covering the interest on the debt with an ICR of 10.28. Number 7, Sherwin-Williams, ticker SHW, which was founded in 1866. In 1875, Sherwin-Williams started selling ready-mixed paint. And did you know, before that, consumers bought paint ingredients that they would mix themselves? They now operate more than 4,900 stores in over 100 countries. They own brands like Valspar, Minwax, Krylon, and Dutch Boy, and they're AI resistant because, physical paint is always going to be needed. Professional painters rely on their store network, and even if AI were to do the painting, the paint has to come from somewhere. Now, Sherwin-Williams has a ROCE of 19.93%, so it's close enough for me to be at the 20% level, so they just squeaked in there. And they have a dividend safety score of 87, very safe, and they look to be toward the high end of their reasonable valuation. Hey, and Sherwin-Williams has 45 years of consecutive dividend increases. They last raised that 18% in February of 2024, and they have a 20-year CAGR of 13%, so they grow that dividend pretty quickly. Sherwin's giving you $2.86 of dividends per share per year. There they are toward the high end of that expected price range of reasonably valued. Probably a bit expensive, so this is one for the watch list. The dividend yield is below the 5-year average, and the forward PE is above the 5-year average, so you kind of want to see these two flipped, where the dividend yield is above and the forward PE is below the 5-year averages. Very, very low free cash flow payout ratio of 34% for Sherwin-Williams. Now, they get a little bit cyclical with the down and the up and the down, but in general, they are moving up and to the right. And next 12 months, analysts expect them to have $11.40 of free cash flow per share, which would match their previous high of $11.40 in 2020, when everybody was stuck at home and tired of looking at those same colored walls. So everybody was buying paint in 2020. You can see the cycles through the sales growth for Sherwin-Williams. They'll have down years, then big up, then down, then big up. But currently it looks like we're heading into a down cycle. So hopefully the share price is going to follow that and it'll get a bit cheaper. 255 million shares outstanding. Not a lot of shares outstanding. Total sales though at a record high of 23.1 billion. Very high return on equity. Remember that can be skewed by debt. Return on invested capital of 22%. Very very, very solid. 9% free cash flow margin. Hey, we'll take it. It would be nice to see double digits. But just like with friends and spouses, companies that you invest in are never going to be perfect. Their net debt always looks a little bit high, currently at 74%. But just like Home Depot, they have a very low net debt to EBITDA, and the interest coverage ratio is 9.19, so they can easily cover the interest on the debt right now. Hey, if you would be so kind, drop a comment below letting us know which of these interest you the most, or which ones do you think should have been on this list. Hey, if you got value from this, thumbs up, you know the drill, subscribe if you'd like to. And who doesn't love a good story like how Ronaldo really wasn't the one that was responsible for a 4 billion drop in Coca-Cola's share price, where in this floating little box next to my head, I talked with Professor Stephen Forrester about his new book. So we got some good stories for you there, and I hope you will click the floating little box next to my head so we can talk to you there.